Hello everyone, my name is Craig Yoakum and I'm a financial advisor with Henderson Brothers Financial Partners. We're excited to share a brief mid-year market update where we'll discuss the economic and market changes that we've seen so far in 2026. We'll also review broad market index returns and finish with the key items our investment team is watching as we move into the second half of the year. I'm joined today by two members of our investment team, investment strategist Joseph Kelly and senior investment strategist John Kirkpatrick. But before passing it over to Joe and John, I want to take a moment to recognize an important milestone. 2026 marks 250 years since the signing of the Declaration of Independence, an incredible milestone for our country. Henderson Brothers, the parent company to Henderson Brothers Financial Partners, also has a long and proud history. Since our founding in 1893, we recently celebrated 133 years of serving our clients and their families. At Henderson Brothers Financial Partners, we continue to embrace the same principles we were founded on. Our team remains committed to helping clients make confident, informed decisions as they navigate a world that continues to evolve at an incredible pace. With that, I'll turn it over to Joe to get us started with the mid-year market update.
Hi everyone, thank you for taking the time to watch our mid-year market update. The market and the economy have once again surprised many by showing resilience in the face of uncertainty. Markets have absorbed multiple shocks so far this year, including a geopolitical conflict in Iran, a global energy supply shock, and elevated inflation. Despite this, risk assets such as stocks have held up better than many expected, and the economy has continued to show signs of solid growth. Of course, this resilience doesn't mean that risks aren't present. We'll touch on some areas of concern that we have throughout the presentation. With that, let's jump into the numbers. U.S. stocks, as represented by the S&P 500 index, are currently up about 9% through the first half of 2026. This is a very strong performance given the headwinds present, and it also builds on strong results over the past 3 calendar years. However, the returns of individual stocks beneath the surface have been more mixed. Nearly 200 companies in the index, or about 40% of the constituents, have posted negative returns so far this year, and almost 50 companies are down more than 25%. Strong gains in sectors such as technology and energy have driven much of the overall return, while areas like industrials, materials, and real estate have also provided support. Within fixed income, returns have been more modest, but bonds have continued to provide diversification benefits. U.S. bonds, as represented by the Bloomberg U.S. Aggregate Index, are up roughly 1% year to date. The primary headwind for bonds has been inflation. Investors typically demand higher yields to compensate for elevated inflation, which pressures the prices of existing bonds. On the economic side, the most recent year-over-year inflation reading, which measures the change in prices of goods and services, came in at 4.2% through May. This is the highest annual increase since 2023. Much of this rise in prices has been driven by energy, which thankfully has begun to moderate from recent peaks. In the bottom right, the current interest rate range set by the Federal Reserve is 3.5% to 3.75%. This rate directly influences the interest rates received from savings accounts, money market funds, and CDs, and it also influences borrowing costs more broadly. The Federal Reserve adjusts this interest rate to help manage inflation and support the labor market. The current market expectations are that the Federal Reserve shifts this slightly higher over the next year to help stabilize prices. Now, we have seen some volatility in investment prices throughout 2026. Returns for stocks were essentially flat in January and February before pulling back sharply in March in response to the conflict in Iran. Bonds actually outperformed stocks for much of the early part of 2026, but that trend reversed in mid-April as concerns began to ease. Much of the positive performance we saw throughout the second quarter was driven by strong company earnings, both domestically and abroad. This chart shows the estimated annual earnings growth rates for public companies in the U.S. and across key international markets. The 13% year-over-year earnings growth in the U.S. for 2025 was very strong, but expectations are even higher for 2026. At the same time, certain markets such as Europe and emerging markets are estimated to have delivered higher earnings growth than the U.S. in 2025. Emerging markets in particular are expected to build on that momentum with an extremely strong 49% earnings growth rate projected for 2026. And this strength has been reflected in international stock market returns so far this year. On a year-to-date basis, emerging market stocks have outperformed U.S. equities, which are up roughly 9% as shown on the left side of the screen. International developed stocks, meanwhile, have performed closely in line with the U.S. This is important for a globally diversified investor, as the potential diversification benefits of investing in international markets have also come alongside strong performance. Now, John is going to go a bit deeper into some of the areas I've discussed, as well as highlight the key market themes we are monitoring.
Thanks, Joe. If you think about the past few years, inflation has really been the story driving markets. We went from a period where inflation barely registered to one of the fastest spikes we've seen in decades, and now into a phase where it's coming down, but has stalled at a level higher than what the Fed considers normal. We've made real progress. The peak is clearly behind us, but as of today, inflation is still running above the Fed's long-term target, especially in areas like services and wages, which tend to move more slowly. Historically, that last step from better to fully under control is usually the hardest. It's why the Federal Reserve has been so cautious. They don't want to declare victory too early and risk a second wave. So when you hear the phrase higher for longer, this is what it refers to. From an investment standpoint, the story here isn't that inflation is a crisis. It's that we're settling into a more normal, but still elevated environment. And that has real implications. Interest rates stay elevated, bonds continue to provide meaningful yield, and income becomes a bigger part of the portfolio than it was just a few years ago. Now, if inflation is one side of the story, the labor market is the other. Because for the Fed, this has always been a balancing act. They want to slow inflation, but they don't want to break the job market in the process. And so far, what we've seen is actually a fairly constructive outcome. Unemployment continues to remain steady and below long-term averages. If you look at this chart, job growth has clearly cooled from those post-pandemic highs, but importantly, it hasn't rolled over. It's still positive. It's just more moderate. In fact, recently we have had 3 consecutive months of strong job gains. And that's important because a strong labor market supports consumer spending, which is still the backbone of the U.S. economy. At the same time, the cooling trend helps relieve some of the wage pressure that feeds into inflation. So what does that mean? It means we're likely in an environment of slower but still positive growth. Not booming, not contracting, just normalizing. And for investors, that kind of backdrop tends to favor balance. Not overly aggressive, but not overly defensive either. Now let's shift from the macro backdrop to 3 key themes that are driving markets today. First is AI and the CapEx cycle. We're seeing an unprecedented level of investment from mega cap companies, with total capital spending expected to approach or exceed $500 billion annually across the largest platform companies. That's a real measurable investment trend, not just a narrative. The key question going forward is how quickly that spending translates into earnings and productivity gains. In the near term, it's also creating index concentration risk, which reinforces the case for active management. Second is the activity in the IPO market. After a relatively quiet period, we're seeing a meaningful pickup in activity and significantly large IPOs. The combined anticipated market cap of SpaceX, OpenAI, and Anthropic is 4.7 times larger than the 10 largest IPOs prior. While allowing broad investor access to these companies is a positive, the question on how the market will absorb these large issues remains to be seen. Third is geopolitics. Between ongoing conflicts and evolving trade policy, geopolitical risk remains elevated, although the market seems to have moved past the current conflict with Iran. While markets have been resilient, events like disruptions in key global trade routes or energy markets remind us that risks can materialize quickly. So the bottom line across all 3 themes, diversification, selectivity, and risk management, remain critical in this environment. So as we turn the page to the second half of the year, there's no single outcome we're anchoring to, but there are a few key signals we're watching closely. At the top of the list is the Fed. Not just what they do, but how their outlook evolves, especially in the Kevin Warsh era of limited forward guidance. Warsh's first FOMC meeting was much more hawkish than many had expected, and price stability was at the center of the statement and press conference. Markets have priced out any cuts for the remainder of this year and now expect 1 rate hike before the end of the year. Right behind that is earnings, because over time, fundamentals win. We're watching whether earnings growth starts to broaden beyond the largest companies and whether margins hold up in a slower growth environment. We're also paying close attention to policy, especially with midterm elections in focus, and what that could mean for regulation, taxes, and specific sectors. And then there's credit. Credit spreads have remained calm and are back at pre-Iran conflict levels. Credit markets tend to pick up stress early. Spreads, lending conditions, and defaults can tell us a lot about where the economy might be headed before it shows up elsewhere. And finally, coming back to AI, the next phase is monetization. We've clearly seen the spending. The question now is, when does that translate into real, sustained earnings growth? So when you put it all together, the message isn't caution or optimism, it's discipline. There are a lot of moving parts, but the foundation is still intact. And in this kind of environment, staying diversified and focused on long-term outcomes becomes even more important.
We wanted to leave you with a few key takeaways that we believe are especially important in today's market. The first likely comes as no surprise, but we believe it remains critically important, and that is continued diversification within investor portfolios. It is important to consider all asset classes as well as the opportunities within each when constructing a portfolio aligned with an investor's long-term financial goals. The second point relates to fixed income. There are opportunities today to generate meaningful yield without having to move significantly up the risk spectrum. And finally, we are operating in a very noisy environment when it comes to investment themes. Our team will continue to evaluate opportunities and invest with discipline, as we believe that will be key moving forward. We want to thank you for taking the time to watch our Midyear Market Outlook. As always, please feel free to reach out to a member of the Henderson Brothers Financial Partners team if you have any questions.